Breaking right now, America. New IRS tax updates for 2026 are officially out, and they could impact millions of middle-class Americans and retirees. According to the Internal Revenue Service, IRS.gov, the agency has released inflation-adjusted tax brackets, updated standard deductions, and key retirement-related changes, all set to take effect for the 2026 tax filing season. And now, as reported by AP News, the IRS is preparing to open the 2026 tax season in late January, with more than 160 million tax returns expected to be filed. That surge is already raising concerns about processing delays, refund slowdowns, and costly planning mistakes, especially for Americans who don't prepare early. At the same time, financial experts speaking to Kiplinger and Investopedia warned that these changes could quietly affect retirees, Social Security recipients, and Americans over the age of 45, particularly those living on fixed incomes, relying on 401ks, or drawing from retirement savings. And here's the part most people are missing. While higher standard deductions may help many taxpayers, small changes in income threshold and retirement rules could actually mean higher taxes for some households, without them realizing it until they file. So today, we're breaking down what's changing, who it affects the most, and what every American needs to know right now, based on official IRS data and trusted U.S. financial news sources. Stay with us. All right, let's get into this, because this is official and it's already happening. The Internal Revenue Service, IRS.gov, has now released its 2026 tax updates, and these changes will affect how Americans file, how much they owe, and how much they keep next year. Here's the headline. Tax brackets are moving again. According to the IRS, income thresholds are rising due to inflation. That sounds like relief, and for some people it is, but only if your income stayed relatively flat. If your pay went up, if you took extra work, or if you pulled more money from retirement accounts, you could still end up paying more. This is where people get caught off guard. Now let's talk about something that hits almost everyone: standard deductions. The IRS confirms they're increasing again for 2026. That means more income can be shielded from taxes, especially for married couples and older Americans. But here's the reality. For retirees, deductions don't always offset higher taxable income from Social Security, pensions, or required withdrawals. That's why financial analysts at Kiplinger and Investopedia are warning retirees not to assume lower taxes just because deductions went up. Another important update, and this one matters for timing. According to AP News, the IRS plans to open the 2026 tax filing season in late January, while the agency is also adjusting staffing and enforcement priorities. Translation: simple returns may move fast. Complex returns may not. If you rely on 1099 income, retirement accounts, or investment income, waiting until the last minute could be risky this year. Now, here's a quiet issue that doesn't get much attention. Small income increases, especially for retirees, can trigger higher taxes on Social Security and even higher Medicare premiums without any warning letter. That's why experts quoted by Kiplinger say retirees should watch total income closely, not just withdrawals. And here's the big takeaway so far. These IRS changes are designed to adjust for inflation, but they reward preparation, not procrastination. People don't usually lose money because they made bad choices. They lose money because they didn't know the rules changed. Now, let's slow this down, because this is where it starts to hit home for a lot of Americans. The IRS isn't just changing tax brackets and deductions. There are quiet shifts happening around retirement income, and most people don't see them coming. If you have a 401k, an IRA, or any retirement account, withdrawals matter more in 2026, especially if you're over retirement age. One extra withdrawal, one unexpected expense, one decision to pull a little more cash, that income adds up quickly. And once it does, it can move you into a higher tax range without any warning. This is something financial experts at Investopedia say catches Americans off guard every year. People focus on how much money they take out, but not how that money is taxed. Now add Social Security into the mix. Small increases in total income can cause more of your Social Security benefits to become taxable. And in some cases, it can even raise Medicare premiums. No letter, no alert, no heads up. You find out when you file. That's why analysts quoted by Kiplinger are urging retirees to track total income, not just monthly withdrawals. Next, refund timing. This matters for millions of households. According to AP News, the IRS expects more than 160 million returns next season. And while some refunds may move quickly, returns involving retirement accounts, investments, or multiple income sources could take longer. If you rely on that refund to pay bills, cover medical costs, or manage debt, waiting until the last minute could create stress you didn't plan for. Here's the key point so far. The IRS isn't calling these changes tax increases. They're calling them inflation adjustments. But inflation adjustments don't help everyone the same way. They reward people who prepare early and punish people who assume nothing changed. Most Americans don't lose money because they did something wrong. They lose money because the rules changed quietly and they didn't find out until it was too late. And that's exactly why this matters now. So what should Americans do right now, before 2026 even gets here? First, check your income, not just your paycheck. Look at everything coming in. Wages, side work, retirement withdrawals, Social Security, investment income. It all counts. Small increases across multiple sources can push you into higher taxes without you noticing. Second, pay close attention to retirement withdrawals. If you have a 401k or an IRA, don't assume pulling a little more won't matter. That extra withdrawal could affect your tax bracket, your Social Security taxes, and even your Medicare premiums. Financial planners say this is one of the most common mistakes they see. Third, don't wait until January to plan. By the time tax season opens, most of your options are already gone. Adjusting withholding, timing income, spacing out withdrawals. Those decisions work best before the year ends. Fourth, get your documents organized early. 1099 forms, retirement statements, investment records, returns with multiple income sources are more likely to face delays and mistakes. Being prepared can mean faster processing and fewer surprises. And finally, don't assume the IRS will warn you. They won't. No email, no letter, no reminder. The impact shows up when you file, and by then, it's already locked in. Here's the bottom line. The 2026 tax changes don't require panic, but they do require attention. A few smart moves now can protect thousands of dollars later, and that's why staying informed early matters more than ever.